Welcome back to the Pod Digest. In this episode, we summarize the podcast episode that discusses investor beliefs and financial advice, drawing upon research conducted by Steve Utkus. He discusses investor beliefs and financial advice, drawing upon his time at Vanguard and collaborations with academics. The conversation delves into the following key themes: investor beliefs, ESG investing, and financial advice. First, investor beliefs. Steve emphasizes the need to understand investor beliefs, arguing that historical performance data alone is insufficient. Understanding investors' expectations about the future plays a crucial role in financial forecasting and wealth management. He describes the innovative survey methodology employed at Vanguard to study investor beliefs. Some key features were biweekly survey, allowing for tracking changes in beliefs over time; simple design to facilitate participation via smartphones; focus on key variables, includes questions about short-term and long-term stock market returns, interest rates, and economic growth. Personalized variance estimates is a novel approach that captures investors' individual assessments of risk, specifically asking them to distribute 100 points across different potential return scenarios. Continuous participation encourages consistent participation while allowing for drop-ins and dropouts, with statistically similar replacements to maintain time series consistency. Integration with portfolio data. Vanguard's unique access to anonymized account-level data allows researchers to connect beliefs with actual investment behavior. Steve highlights the unique advantages of survey data in understanding investor behavior, particularly its ability to reveal the rationale behind investment decisions, which cannot be gleaned from behavioral data alone. Steve outlines 5 key findings from his research on investor beliefs. Fact 1. Limited sensitivity of portfolio allocation to expected returns. Despite changes in their expectations about future stock market returns, investors' portfolio allocations remain relatively stable. Specifically, a 1 percentage point increase in expected returns only leads to a 0.7% increase in equity allocation. This suggests a sluggish behavioral response to changes in expectations, potentially influenced by cognitive limitations, tax implications, and administrative burdens. Interestingly, downside risk, particularly the probability of a stock market disaster, has a much stronger influence on portfolio allocations compared to overall variance. Fact 2. Beliefs primarily affect trade direction and magnitude, not frequency. Changes in beliefs do not necessarily lead to more frequent trading. However, they do influence the direction and magnitude of trades, with investors more likely to buy stocks when their expectations about future returns increase. Fact 3. Persistence of beliefs. Individual investors exhibit consistent optimism or pessimism over time, with their beliefs remaining relatively stable. This suggests the importance of understanding individual investors' baseline beliefs in managing expectations and facilitating productive conversations about investment goals and potential outcomes. Fact 4. Alignment of cash flow. Expectations and expected returns. Investors' expectations about future stock market returns are generally aligned with their expectations about economic growth and future cash flows. This suggests a coherent understanding of the relationship between economic performance and stock market returns. Fact 5. Impact of disaster probabilities on expected returns. Contrary to traditional finance theory, investors who perceive a higher probability of a stock market disaster tend to expect lower, not higher, stock market returns. This finding suggests the need for more nuanced models that account for investors' heterogeneous beliefs about potential market outcomes. Steve discusses how investor expectations evolved during the COVID-19 stock market crash, based on Vanguard's special surveys conducted in March and April 2020. Expected returns for the S&P 500 declined but remained positive, suggesting investors did not anticipate a prolonged market downturn. The perceived probability of a stock market disaster doubled, reflecting heightened concerns about market volatility. 10-year expected returns remained relatively stable, with some investors even expecting slightly higher returns due to the market decline. A majority of investors, 70%, did not make significant changes to their portfolios. Among those who did trade, optimists reduced their equity holdings by a greater percentage compared to pessimists, but the overall shifts were relatively small. The lesson Steve desires to convey is the importance of staying invested during market downturns. Frequent trading based on short-term market fluctuations can be detrimental to long-term investment success. ESG, environmental, social, and governance. Investing. There are three primary reasons for investing in ESG assets: ethical considerations or the desire to do the right thing. The second most cited reason was climate change and mitigating climate risk. A smaller group believed ESG investments will outperform traditional investments due to factors like the potential for stranded assets. Investors who prioritize ethical considerations or climate change concerns tend to allocate a portion of their portfolios to ESG products, even if they expect lower returns. Interestingly, investors who believe ESG investments will lead to higher returns allocate a larger share to ESG products. Financial advice. Steve discusses the impact of Vanguard's hybrid robo-advisor, which can be a valuable tool for investors, particularly those who were previously DIY investors. Robo-advisors effectively address common portfolio construction errors, such as holding excessive cash, lacking international diversification, and not having a structured approach to determining equity risk share. This leads to improved portfolio efficiency and higher Sharpe ratios. Switching to a robo-advisor frees up approximately 6 hours per year that investors would otherwise spend monitoring and managing their portfolios. However, this does not include the time required to acquire financial knowledge and develop investment strategies. Robo-advisors particularly benefit investors who make significant portfolio construction mistakes and those seeking a more structured approach to portfolio management. Steve explores the needs that human financial advisors fulfill, particularly in the context of increasing automation. Traditionally advised clients cite the human element as the primary reason for not switching to robo-advising. They prefer having a personal relationship with an advisor, expressing concerns about trusting algorithms with their money. Non-pecuniary benefits. Human advisors provide peace of mind, expertise, and a sense of delegation, which are highly valued by clients. Research suggests that emotional factors contribute as much as financial factors to the perceived value of financial advice. Client needs. Trust and transparency are the most important factors for clients when choosing an advisor. Self-improvement, i.e., getting organized financially and having a plan, and access to knowledge are also highly valued. Investment performance, while important, is considered less critical compared to these non-pecuniary benefits. Differences between advised and unadvised investors. Unadvised investors place less emphasis on trust and knowledge attributes, as they are responsible for managing their own finances. However, they may rely on institutional brand trust when choosing financial service providers. Understanding fees. There is a widespread lack of understanding about financial advisor fees. Many clients are unsure about how their advisors are compensated. A significant portion refuses to disclose how much they pay in fees. Those who do report fees provide wildly inaccurate estimates, with the average reported fee being 6.7% per year. This lack of transparency emphasizes the need for clearer fee disclosure and communication to help clients make informed decisions about financial advice. Steve's research demonstrates the significant impact of advisor quality on client behavior and retention. High retention advisors. These advisors proactively communicate with clients, particularly during periods of market calm, building trust and solidifying the client relationship. This proactive communication leads to greater client trust and reduces the likelihood of clients leaving the service during market downturns. Low retention advisors. These advisors tend to communicate less proactively, and client interactions are often initiated by the client. This reactive approach can erode trust and increase the likelihood of client dissatisfaction and attrition during challenging market conditions. Quantifying the value of advisor quality. Steve modeling estimates that a high-quality advisor can increase lifetime total returns by 30 basis points, while also boosting firm profitability by 25 basis points. These findings underscore the tangible economic benefits associated with high-quality financial advice. Recommendations for financial advisors. Steve concludes by offering recommendations for financial advisors to enhance their value to clients in an increasingly automated world. Some of them are: develop empathy, communication clarity, and active listening skills to foster strong client relationships. Clearly explain the investment methodology and rationale behind portfolio decisions to build trust and transparency. Leverage technology to enhance efficiency and knowledge access while recognizing the importance of human interaction and explanation. Clearly disclose fees and articulate the value provided beyond pure investment management, encompassing financial planning, behavioral coaching, and emotional support. Steve's research highlights the critical role of building strong client relationships, communicating effectively, and demonstrating expertise to deliver tangible value to investors seeking financial guidance and peace of mind.